Let's talk housing, Carolyn, because pending home sales rose 3.1% in the month of February, reaching the highest level since June of 2013. Now, the gains were primarily driven by sales in the West and Midwest. Meanwhile, housing starts fell 17% for the month of February, with existing home sales rising only 1.2%, as you can see right here. We'll get more of a picture of the health of the U.S. housing market with the S&P Case-Shiller Index, which is out at 9 a.m. Eastern. So let's discuss more about the opportunity in the housing sector with Shari, Olefson, director of the Carnegie Group. She joins us from New York City. Shari, thanks so much for joining us. Is there a lack of inventory of entry-level workforce housing homes? And if so, what's driving that?
That's the exact problem with U.S. housing right now. And there are several factors that are driving it. First of all, when it comes to existing home sales, we know 5 to 6 million folks are still underwater. Now, we had the Mortgage Debt Forgiveness Relief Act, which allowed those people to sell without having to pay income tax on the amount of debt that the bank forgives. But that expires at the end of this year. So there are proposals to extend it another 2 years. Hopefully that will happen. That will add to some of the inventory. We also know there's been a huge lack of new construction in this price range. Only about 20% of new homes now are affordable, and new construction in general has dropped from $1.5 million to, under 300,000 when the bubble initially burst. We also know that people are locked into their homes. U.S. folks used to keep their homes for 6 years. Now they're keeping their homes for 10 years, oftentimes because they bought or refinanced when rates were really low. So there's a lot of factors going into this right now, but the bottom line is only about 60% of existing homes are affordable and about 20% of new homes, and the number overall of those homes is down itself.
So, Shari, what are you suggesting should be done? Is it the government's fault? Should it be the private sector that's picking up the slack here?
Well, what's going to happen is the private sector will eventually. It's going to take some time to turn this ship, but, developers will go where the money is. So as soon as the risk is reduced a little bit and the margins increase, we'll see more new construction of homes in this price range. The big thing the government can do is not mess it up. So again, extending that Mortgage Debt Relief Act is going to help adding inventory. But the real biggie in the long term is not messing with exemptions that encourage people to invest in real estate in the first place. And in particular, the capital gains exemption, which allows people to sell their homes and keep up to $250,000 of profit for a single person, $500,000 for a married person, without paying capital gains on that. The reason that's so important is we've got all these boomers who are retiring and hopefully will be selling their homes. We've got all these millennials, 75 million of them, who we know have put off buying homes, but we could really free up a lot of inventory with boomers being able to sell and keep that money due to the capital gains exemption, not only for their retirement, but again, freeing up that inventory.
Of course, that's been a trend that we've been witnessing. The millennials, they love to rent. They don't want to buy. Of course, the question is, will that change? I want to ask you about lending conditions, though, Shari, specifically for the developers who need to take out a loan to build more property. Will lending conditions improve?
Well, and that's an interesting question, too. Yes, lending conditions will improve. There are already some proposals to loosen up some of that lending. The biggie is going to be that the risks that the bank perceives those developers taking on. But, Fannie and Freddie recently started these lower 3% down mortgage payments, mortgage loans, and borrowers can actually borrow as much as 100% of the down payments from friends and family. So Freddie just started those last week. Fannie started those in December, but it takes a while for the underwriting to get in line. I think that's going to really encourage a lot of developers to build because they know that their buyers will now be able to get financing, which has been a big issue.
Yeah, and of course, how do you foresee the housing picture in general changing once, in fact, rates do rise?
Well, we know that housing will become even less affordable. So, for example, if prices go up by about 5 or 6%, which is what we expect this year, rates go up by 1%, we're looking at homes being potentially as much as 20% more expensive for folks to own. The biggest saving factor there, though, is that rents are actually rising faster. So we've had a 15% increase in rents over the last 5 years. We know that even today, rent makes up about 30% of an average renter's income, whereas mortgage payments make up about 21% of an average buyer's income. So as long as buying remains less expensive than renting, it's still going to be the better option.
That's a big story. Shari Olefson, thank you for joining us today here on Worldwide Exchange. That's Shari Olefson, director of the Carnegie Group.